or sorry, a button. All right, good morning, everybody, both online and in person. We have a really exciting, I think just a lot of info-based presentation for you guys today. We brought Varan back with his team from Fidus Mortgages, our new team name. But we're going to have a lot of fun. We've got two speakers today. We've got Elaine, did I say that correctly? Perfect. From BMO. He's going to be talking about, I think, pre-construction properties, mortgage options for short-term rentals, high net worth individuals, gifted down payments for investment properties, a bunch of topics. And then we also have Kelly that's going to be talking from RFA Mortgages, who's going to be talking about different flexible solutions such as 35-year amortizations, contributory income, mortgage options for small business owners, and solutions for clients with bruised credit. So these are probably all different things that you guys may have in your clientele base, just all different types of scenarios. So there's not really just a cookie cutter type of buyer out there. So it's nice to know that you guys have a mortgage team and some options for all of your clients with different situations that aren't just straightforward, regular buyers. So I don't know, Brian, you want to say hello to our audience?
I got
Brian?
I don't got anything to take over. I got anything to take over.
We're gonna have a nice little lunch and learn after this for you guys, but I'm gonna let you get started. And
Thanks. You want to put the...
yeah, I will put our presentation up. So we have a little audience online, so you're gonna be talking to a lot of people.
That sounds good.
No pressure.
None.
Online people, if you cannot hear, please let us know. And then we will get to it. If you guys have questions, maybe leave them for the end. I did have a request to repeat the question out loud, so maybe I'll come up here and ask the questions and then we'll let you answer them.
Yeah.
But in the meantime,
I think we're going to do the same for anybody that has questions here in
yeah,
the room.
questions you prefer at the end or during?
Honestly, I my style is more conversation, so
Okay.
I am open to it.
Okay.
So don't feel shy.
Perfect. Okay, so maybe in person, if you guys are in person, you guys can ask questions throughout, and then my online people will come to afterwards.
Yeah, let's do it that way.
Cool.
How's it going, everybody? Online and in person. My name is Alain. Work at BMO. It's been a couple of years now that we launched since we launched our broker channel. So today we're going to talk about our relaunch in the broker channel, distributing our mortgages, and then get down to who we deal with, who we distribute through, and what kind of products and features you guys can benefit and your customers in the long run. So a little bit about myself, been in the mortgage business for 22 years. That makes me a little bit old, but yeah, about 22 years. Different banks mainly, and in the broker business since 2017. So I have a good understanding of the background. I used to be a mortgage specialist, worked very closely with realtors. I know what's in it for you guys. I know what the customers want in the end as well. Try to make this as smooth as possible today. So I like to have that conversation. I'm going to talk high level because you guys don't get into the weeds. But if you have specific questions, I'm really open to respond to them. This is, for information. So please ask away. Don't be shy. So I'm going to use the mouse here. So we're going to talk very high level. We launched in 2024, last winter in February, and we went very small at our launch. Why? Our focus was really to continue offering a good service, quick turnaround for customers. And we've been expanding at a slow pace to make sure that our pipes are working, our partners, like Varan and his team, are well served, and any feedback, we've been very, very responsive in adjusting, pivoting, improving, and we have a big team behind us supporting us. So right now we're launched in Ontario and Atlantic. We're likely going to launch later on this year in Alberta and probably next year in Quebec. So we're really going slow, and our focus is service. So we have selected to start a few brokerages with whom we started working with, and we started working with Varan at launch last year, and it's been a great partnership since. So it's not launched at every broker's out in Ontario or Atlantic. We're really focused on top producers that can pivot some of their business, work with us, find solutions with customers, grow their business with us, and eventually we're going to continue our expansion once our operations can support extra brokers with whom we can work with. So we work with top, and eventually we'll work with masses within a year or so. Other than that, so how do we offer our services? We decided to go with a very efficient model. So pricing is almost the same in all the channels. Our channel protocols protect whoever submits the deal in first. The broker experience, we have assigned underwriting for them. We have a quick turnaround, so usually it's 24 hours to get a commitment back. Same thing, you send a pricing exception. So we've been quite flexible with our pricing to get business. We get pricing responses back with quite competitive rates, and I hope Varane can support me on that one as well. Other than that, we have a lot of features that help customers get a little bit more when they sign in with us. So we have our cashback campaigns that help them with the closing costs, but we also have additional cash that we can offer them if they open banking services and get other services with us as well. So we do that through our welcome advisors. So because we are mainly virtual in the way we operate, we have welcome advisors that will contact. So sorry about, I think everything is a little bit off on there. I apologize. I just realized. So we have welcome advisors that are virtual, that are going to contact the customers once the deal is approved and once the deal funds. This offers really full support for your customers in the end, so that they feel comfortable once they get their financing with BMO. All right, so we don't just get the mortgage financing and then leave them be. So any questions they have, they are supported. We have a team that does that for them. Products and programs are pretty much the same across the board. We will have some little nuance between our proprietary channels and the broker channel, but that represents roughly 1 to 2% of our book of business. So I don't think it will impact you guys very, very much. And I think we'll have most of the solutions you're looking for your customers. Any questions up to now? No? All right. So let's talk about our program. So where do we stand out? I know all banks kind of have similar products, similar features. So these are where we kind of stand out compared to our competitors out there in the market. The biggest one, I would say, is our rental program. Why is it different? Couple of things. Number one, we can go up to 10 rental properties per borrower, as long as 5 are free and clear. So it's technically 5 finance properties per borrower. So let's say I have 3 rental properties, you have 4 rental properties, we're purchasing together another one. I would be at the top in terms of number of properties. No, I would have an additional one that I can purchase in the future. You would be at the top because you would have 5 rental properties. Total is going to be 7 plus the one we're financing 8. So the number of property finance is per borrower. So that makes a big difference, especially for investors out there in the market.
You're bringing 2 different owners to play here. Or are you guys?
It's just to give you an example. So the number of rental property finance is per borrower. So if it was just myself, I have 4 rental properties, I want to buy a 5th one, I would be at the top in terms of the number of finance properties the bank is willing to finance on the broker side.
Assuming those 4 are free and clear?
No, they could be financed. Okay. If I had 5 and I'm buying my 6th, one of them has to be free and clear.
I see. Okay.
To go on the broker side so that Varane can finance it. Okay. Now, if there's multiple borrower, the number of finance property is per borrower and not per application. So that kind of gives a lot of loose in this space. Sometimes because we focus on SLA. The reason why we limit it is so that the more that there is, the longer it takes to underwrite these deals. So like typically, just to give you a context, a rental deal can take 2 to 3 hours to underwrite. There's 8 hours in a day. We want the underwriters to do about 10 deals a day. So that really limits the number of deals they can underwrite per day. So we really try to focus on limiting that so we can work on the masses. But our programs allow for a little bit more. Our policies are pretty smooth. So for example, on a subject property, we'll use up to 90% rental income. and keep everything in the ratios. We can do offsets for non-subject properties, and where we actually differentiate ourselves based compared to our competitors is if you have a rental loss or rental surplus, it's either removed or added to the income versus creating a liability and increasing the TDS that way. I know it's very technical. I don't know if you all are familiar with TDS and GDS, but if you add a payment, that increases your TDS and limits your purchasing power. If we remove it from the income, that kind of improves your purchasing power. Yes.
It's 50%, right? Is it different with BMO or?
Yeah, so every bank has their policy. Where we kind of stand out is for subject properties, we will use up to 90% rental income and keep the payments in the ratios. Other banks will use, and the insurers will use 50% of the rental income.
What's the turnaround time on financing?
We aim for 24 hours for the commitment, right? So like just to get your approval. So once you submit your deal in, we expect that within 24 hours, either you get a response or a questions back from the underwriter. So meaning that they reviewed the deal, have questions, they want more information, or they're comfortable with the way it's presented, and we can give an approval within that time frame.
Still a 5-day condition probably to be on the safe side on finance.
Always. If you do 2-day condition financing.
I tend to,
So all the documents are, of course, presented or submitted, right?
That's the caveat. So I'm originally from Quebec. When I moved here to Toronto, I kind of had a bit of a how can I say panic attack, anxiety attack with the 5-day turnaround, because usually in Quebec it's like 10 days COF.
10 days.
Yeah, 10 to 14 days COF. Yeah. Yeah, it's a different breed, but they also need a final approval. So they can't just waive a condition of financing. So it's a bit of that counterbalance. But 5-day turnaround time. So by the time you get your approval, ask your customer for the documents. Sometimes if they have a more complex situation, they're going to go dig for their documents. That's an extra 2 days. So you really have 2 or 3 business days, not even business days to get a condition of financing. So we do prioritize when there are COFs so that we meet the deadline. Sometimes we'll have to ask them to push if we get it way too late, and we know it's a complex deal. So we'll usually communicate with the broker and say, hey, we'll need an extension just to get you the approval in time.
That's my request from the online world.
Yeah.
Can you repeat the questions?
Oh, sorry about that. Yeah, I will. What was the question again? I responded. All right, sounds good. Yeah. So on the rental side, I think this is where we kind of stand out. The other part where we stand out is most lenders are going to ask that the down payment be from their own resources. We do accept, so we consider gifts as part of being from your own resources, because usually gifts are from direct family members. So we do accept gifts on rental purchases.
Cash gifts.
Well, what's defined cash gift? So online, we got asked, does cash gift count? So I'm asking to define what a cash gift is. Yeah. So we're talking about a pile of cash. On the AML side, because we all have AML, right? We all have to do our due diligence on AML. Yeah, anti-money laundering, exactly. So I'll ask you, what do you think? Yeah.
So,
Listen, I would say between you and I, that's a great answer. The bank is going to be less less receptive to that cash bob. Yeah, exactly. So we'll have to find alternative sources, either a gift or if they have savings, we can show that, and if they want to use the cash in the end, it's up to them.
how long do you need to see the funds?
So the funds typically is 90 days. Yeah. Should I repeat the question online? Yeah. Okay. So I was asked how long do we have to prove down payment, and it's 90 days. So 3 months of bank statements to show that they've accumulated the down payment. Gifts are not that way though. So for a gift, usually we ask for either a snapshot that the gifter has the funds in their account, or we have three options. The second option is if the funds are transferred in the giftee's account, we got to make sure it's 15 days before closing. So we do accept that statements from the giftee showing that they received the funds 15 days before with the gift letter signed. And the third option is the gift letter signed and stamped by the bank of the person gifting the funds, showing that they have the monies available. Okay. Sorry, I'm not looking at this side. I'm going to give you guys more attention. I promise. It's the green shirt, man. So that's about it on the rental program. Any questions before I move on to the short-term rental? We're good. The second part is short-term rentals. I know it's
Just
not,
nothing,
yeah, for
You
sure.
guys are the only one who do a gifted down payment on the rental.
I usually don't like to talk about this.
BMO
I'll
is
let
the only one
Varun.
that takes a gifted- No one else does?
No.
Major banks.
Yeah.
BMO is only major bank. They take the gifted down payment on investment properties. And these are people.
Oh,
So, to everybody online, Ferran said that we are the only bank that accepts gifted down payments for rental purchases. All right. It's not me. Sam. No, I would say no.
Oh.
Yeah. So the next part, short-term rentals, we do them, and I'll explain what you guys need to verify before moving ahead with it. So he needs to do before he sends the deal to us. Number one, we do finance up to 75% loan to value. Okay, that's great. We use up to 80% of rental income. So if let's say you're doing a purchase, right? So it's a subject property. We do 80% of the rent. And then so if it's a new short-term rental, we'll have to get market rent, and that's fine. We just have an appraiser come and assess what a short-term rental income would be. Obviously, it's not going to be the same as if it was an established short-term rental, but it is a little bit more substantial than a regular yearly rent.
What is a short-term rental? Airbnb?
Airbnb, VRBO, that goes into that category. VRBO is those cottages, that you can rent online. They are usually short-term, and we do finance them. The caveat with short-term rentals is we got to make sure that there are no municipal bylaws that are restricting the short-term rental. So we do mandate the solicitor and lawyer to do that verification at the end. Now, if we haven't done our due diligence and we get to the lawyer and they say we cannot finance because of municipal bylaws, the short-term rental, that kind of kills the deal. So let's make sure we do our due diligence up front, make sure there's no restrictions so that we can, complete the financing. Doesn't mean we won't be able to look at that property, but we might look at it more as, regular rental. That's why it's important to know it up front, because midway changing the vocation of our financing application might kill our deal. So I'd rather get all the information up front when the submission is sent. So if you can help Varun and his team kind of help figure out if there are municipal bylaws restrictions, we should know up front about these short-term rentals. Any questions up to now? No? Excellent. I am clear, apparently. The other program that's important with us is the Savers Advantage program, which is a net worth program. I'm going to be very high level on this. It's really to anybody that has a TDS of 50% or over and have liquid assets, excluding RSPs, we can help with the financing, even if the ratios are definitely higher than normal. And we don't have a cap. Customer can have 2-3 million in 2-3 million in assets, and their TDS is at 200%. They have little income. If their assets cover the amount of mortgages they hold, we're okay to finance them up to 80% loan to value.
Are we obligated to report these people when we see our? Just wondering.
Not for us. Not on our account. Yeah. So the question came in as, do we need to report these customers to the CRA? And my answer is, I don't, no, not for us. So I'll leave it at that. If you guys have questions on the net worth program, please feel free to ask after the fact. The next one where we actually really stand out is builder completion mortgage. So in the A space, we're the only bank, and I'm gonna say comfortably for this one, in the A space, we are the only bank that does this. In the broker space, there's a lot of B lenders, so alternate lenders that do have that ability. So what's a builder completion mortgage? Essentially, if a customer purchased on plan from a new construction, a builder, sorry, over 12 months ago, or got an assignment over 12 months ago, we could lend to them on today's value. So let's say your customer bought with a builder 4 years ago. That's a fair amount of time for a property to gain value. So if they bought 4 years ago on plan, now the deal's closing. Hey, you know what? I want my property, I think took a lot of value. Can we lend on today's value? Yes, we can. So let's say you bought the property on plan for 500,000. Today's value is 700,000. We can lend up to 80% of the 700,000, even if the value of the financing is higher than the purchase price. We don't mind, as long as we can still prove the down payment that was given originally. We can't use the proceeds, the extra amount that they're going to receive. We can't use that as a down payment. Okay.
What if that was reversed?
In what sense?
Since that you bought 4 years ago.
Yeah.
A lot of people did for 800,000. I was now raising it 600,000. Then we're SOL.
You're just describing the whole
Yeah.
condo market downtown.
That's what's more important.
Yeah. That's a tougher one, to be honest with you. That is the tougher one.
Not in business. To buy it.
Yeah.
But there are some condos, like actually I did a deal with BMO a couple of, close about a month back. They purchased and they appreciate about $150,000. The client actually pulled them.
So instead of the customer, essentially this program is instead of the customer doing the purchase and the next day starting an application to do a refinance to pull equity out, we allow to do all of this upfront. That's the purpose of this program. Just to facilitate instead of having 2 lawyer fees, 2 registrations, we're all doing this under one umbrella. Other things where we stand out, so 130 days rate guarantee, so we can lock in a rate even on pre-approvals with the lowest rate possible. So some of the lenders usually limit the pricing on pre-approvals to whatever the bank is, the target rate is. We can actually ask for exceptions to get lower pricing for your customers and guarantee that rate for up to 130 days. And we've been quite competitive these days as well.
Are the discounts that they offer, are they competitive and are they selective?
They are competitive. What do you mean? So the question is, are the rates competitive or are the rates selective? So
Selective to individual. This guy's worth 2 million, this guy's worth 300, this guy's thinking of buying a house next year.
So we don't do it that way. We're going to look at our cost of funds based on the mortgage amount that comes in. And we're going to determine the best rate for the customer at that point, or what the broker is asking to win the deal. Yeah. We do offer, buy downs to be a bit more competitive. I know the market is quite competitive out there. We are competing not only in the broker space, but with all the banks out there, right? And, as you know, the branches have been quite aggressive in the past 2 years to try to acquire business. Because the business doesn't just walk in the door, right?
So another question, BMO looks after the lender, the mortgage broker putting the deal forward to them, correct? There's no fees to the borrower?
No fees to the borrower. No fees to the borrower. So everything is baked in. Like I said, we're trying to get close to our margins. Brokers are compensated by the bank for sending the deal. There's no fees that are charged to the customers. We actually our contracts with the brokers prevent them charging fees to the customer. So we will cut off a broker that charges fees to a customer. We don't accept that in the A space for us. Yeah. Questions? No?
Not so far.
Not so far? On this side?
Everyone.
All right. Cool. I'm going to talk about other features. This is really uh most of our products right now, it's not updated. Wow, the layout really got messed up. It's Apple, right?
Oh, yours? No, I'm on Apple.
That's not Apple?
You
Okay.
wanna pop it open and?
It doesn't matter. Honestly, I'll just go very quickly. This part is not super important. I really want to talk about
You have PowerPoint here?
Yeah. Yeah.
Maybe just open it up.
I don't know if it will change it though. No.
It's
Go to the email and just do open it.
I'm just gonna keep.
yeah, I'll explain it.
But it transferred in that format on PowerPoint.
So a couple of things I really want to talk about here. So our programs are all outlined on the left side. Owner occupied, I mean, that's pretty standard. Our sliding scale though in the GTA is something to note. Our sliding scale starts at 2.5 million. So we'll go 80% of the first 2.5 million in the GTA. Which really is quite aggressive compared to our competitors out there. I talked about the rental program. We do finance vacation homes, second homes. We do have purchase plus improvements, and we also have the new insured refinance to build other units in the property. So we do offer that kind of financing. If you know upfront that your customer's looking to do that, to add extra units to create more rental opportunity for them, we do have that opportunity, and Varan can absolutely walk you through it. So we are one of the only lenders in the broker space that do offer that refinance option insured up to 2 million.
So you will include renovation financing on a building that's vacant and the buyer wants to renovate it before renting it out.
Yes, that's correct. Yeah. So there are particularities, and I'll let eventually Brian, I'll have to train you guys on it. But yeah, we do I think the program allows up to 10% of the improved value for the renovations. So give you an example. Property's worth 500,000. You want to build another unit in that property for additional income. The improved value, let's say 700,000, we can finance 10% of the improved value, so $70,000 that we're going to do for the work to add the unit. If it costs more, the customer has to finance it on their own from their savings. Or try to keep it within the 70,000 to make it work.
And those are the prevailing rates, whatever.
Yeah. Yeah, it's actually better because the insured rates are better than the conventional rates. So they'll get a better rate through our because the deal is insured. Pardon me? That's a good question. I don't know yet. We haven't gotten one. So the question for everybody online is how long does it take to get an approval for that kind of deal? I don't suspect it's going to take for the approval itself. It shouldn't take much longer. It might take maybe 2 or 3 business days to get that sorted out. I think the challenge with this one is having all the permits up front. So the insurers don't want the customer to do the renovations and then come to them with, hey, here's the work permit, everything's done. Please let's do a refinance to pay myself back. So what they want to do is they want to be part of that project. So you have to come to the bank and then the insurer once you have the permits to add that extra unit with the cost of the renovations. They're going to analyze all this and give an answer, and then we'll fund the deal, the refinance. And then once the work is completed, so they have 12 months to complete the work. Once the work is completed, then we reimburse the cost of the renovation. So they have to sustain the renovations throughout. Yeah. Yeah, so a purchase plus would have the same process. The only difference here is you have to have the city permits, and at the end they do verify that there was an inspection from the city to confirm that the work is legal and conforming. Okay. What we didn't talk about the insured borrower down payment. So, or insured borrowed down payment or conventional borrowed down payment. So we do have programs where customers can borrow the down payment. They don't have all of the down payment. The premiums are with the insurers are quite expensive, are a little bit more expensive, sorry. And on the conventional side, we do allow it as well. The way it's underwritten is slightly different, but shouldn't impact the length of time it takes to underwrite the deal. We do have another couple of programs that could be interesting as well. So new medical doctors. So if they're in the last 2 years of the residency or the first 3 years of practice, we can finance with a stated income up to 80% loan to value. It's got a more strict sliding scale policy because we know it's stated income. So we are limited in the sliding scale. Again, Varane would be able to guide you if you have situations like that. I don't know if switches is worth it for anybody here, but we do switches as well. And we cover the cost for the customer to bring the mortgage over. Other little cool features I think would be worth noting is we have a mortgage cash account. So let's take the example of a customer that has a variable rates. Rates have been going down. They're paying off their mortgage capital a lot faster that way. Let's say down the road, they paid down $25,000. We allow the customer to take that $25,000 back, blend it with their current rate without having to go back to a solicitor and, refinance the property. So we essentially allow them to pull whatever they paid off from their house and, have access to that money. We'll blend the rate based on today's rate and the remaining term. And they would be able to have access to whatever they put into their house. I think this is a cool feature that for you guys to know and to direct some of that business to Varane because these are embedded in all of our mortgages.
Qualify.
Pardon me? No qualifying, no documents, nothing.
Simple question.
Yeah.
Got mortgage, certain banks who've had them for years and years and don't feel like they're really doing anything for you. They're kind of locked in. You want to go somewhere else, there's a few qualifying, all the hoops and loops you gotta run through. But you said you'd love to take, business, mortgages from other banks, but again, you've got to go through the whole process, right?
Yeah. Yeah.
I don't understand when somebody has a history, never miss a payment in 10, 15 years. Credit score 850, 900, whatever the case.
Mhm.
It's gotta go. There's equity in the home. It's they think they kind of rewrite the script a little bit.
All right. So
There's
I'll
an idea for the
I'll just reiterate your question so everybody understands, and I'll answer it. So, one of the questions I got was, and tell me if I'm wrong in the way I interpret the question. Why do we make it difficult for customers that are well established, from switching from one lender to another by asking for them to reapply from A to Z for a mortgage? Did I get the essence of it? No, I'm talking the industry. Yeah, I represent the banking industry. So the answer to this is pretty. I'm not going to point a finger, but I am. So OSFI that oversees the banking industry requires that we qualify each buyer. So any application we do to bring a customer in or to purchase or to refinance, we need to do our due diligence on the customer. Now, we also need as a bank to know who the customer is. They can have a good repayment history, but we need to understand who they are. This is our duty. OSFI, I don't know if you guys kind of followed, but OSFI came in November with, you don't need to stress test when it comes to switches. Couple of days later, they came back and said, wait, we can't do that. We're going to mandate you guys, the bank, to do your due diligence without giving us guidelines and say, do your due diligence. We don't give you guidelines, but you better have a method to your madness. So most banks kind of came back and said, well, we're gonna have to stress test because we don't know what the Bank of Canada, OSFI wants. So they give us very, very little guidelines on these things. So we have to take those decisions to protect ourselves and to protect the customers in the end and the industry. So long-winded answer, not sure if it gives much, but we are, kind of dictate, like OSFI dictates a little bit what we got to do to protect, the industry. Blame OSFI,
Pass the buck. We will.
right?
Right.
Simple. Yeah. So I put an example here of what this would look like. We also have cashback products. So if you have investors that put money in real estate, you don't care much about the interest rates. They prefer having cash in their pocket. We do have a cashback product. It's a customizable cashback, which allows a customer to get up to 7.5%, up to 50,000 in cashback. So 7.5% of the mortgage amount, with a maximum of 50,000 as a cashback. That influences the rate. The more cashback you get, the higher the rate is, vis-a-vis the posted rate. So if you do a $50,000 cashback, you might get a posted rate, which is close to 6.5%. But again, if your customer doesn't care and prefers having the cash in their pocket and the write-off with their interest rate, these are options that Varan and his team can discuss with the customer.
One more.
Yeah.
This
Yes.
one's an easy. Now somebody's applying for a mortgage, and I'm just kind of starting to advise people, like, if you're scraping to put 20% down to avoid that, land transfer tax, you're gonna get a much better discount on an insured mortgage than a non-insured mortgage, right?
Yeah.
So if they've got like 15% or 17 or 18%, that's it, just close the deal at that, pay the whatever capital gains or capital gains, the land transfer, and you're gonna get maybe 1% discount, if not more.
1% is
I've seen-
it's a big difference. I would say you're probably in the 20 to 30 bips difference.
Maximum half of us.
Yeah, maximum 0.5%.
Or
So
am I thinking on renewals?
no,
Because I've seen,
no, maybe not
Because
like
they
a
bring it
year
up.
from now.
they bring it up on renewals, they're saying, well, yours is not an insured mortgage. I've had different clients. with
Yeah.
The same lender. One was an insured, and that was me,
Yeah,
and my sister or nephew or whatever was non-insured. They got a better discount.
Hmm.
And I have another client with the same lender coming.
but
up for renewal
1%
next month.
difference,
I think so, yeah.
that's a lot. I mean, I haven't seen that with us with BMO. I don't speak for BMO, and Varan
Yeah.
can speak to the rest. Like the difference between our insured and fixed roughly is about 30 to 40 basis points. But it does make a difference the bigger the size of the mortgage, right? Like you can talk about $200, $300, $400 a month difference in payments, depending on the size of the mortgage. Any other questions online?
Yeah, we had one. Do you offer options for accessory
Accessory,
dwelling units?
educate me. What does that mean?
Self-contained residential units?
Laneway home? Okay. Yes. So basement rentals, laneway homes, we do accept them as long as they're legal units. Conforming is not enough for us. So what we're gonna ask is if it's the property you're financing, we're gonna ask that an appraiser confirm that it is a legal unit.
So you mean like getting permits and going to the city?
Yeah.
all that stuff?
Yeah.
Is there like a checkpoint that you guys do or?
What do you mean?
Certificate from the city.
From the city.
Well, certificate from the city, but the way we do it is we ask that an accredited appraiser confirm that to us. So the certificate, you sending me the certificate is not enough. So, yeah, so the appraiser has to make sure that, and there's special appraisers that have that accreditation, sorry. That they make that verification and give us the confirmation that it is a legal unit. That's the way that we protect ourselves that way. Yeah.
But the city, because you've got to have your hydro clearance, you've got to have your fire clearance and whatever else, and the building inspector before they give you that certificate.
Yeah.
So when we put on a listing or we offer a property to a client, it has a certificate making it illegal.
Yeah.
That's on. Oh, that's a deal breaker.
But that's a BMO policy.
That's a BMO policy. You have
The
other
lenders, They
options.
don't even ask for the certificate. They just want
Yeah.
to make sure that it's a credit insurance portion.
So my previous employer just wanted that it's conforming. So that's
Consider going back to the previous employer.
nope.
We choose the lender based on what the client needs.
No, I think this is a great opportunity. Listen, we all have our strengths
Yeah.
and opportunities. You know, can I say like we do a ton of legal basements? No, but we do some. We just have to make sure that it fits within the bank's risk appetite.
If property has a basement apartment, it's not in the equation, then it's not brought into question or brought into
No, I won't.
qualification, and we want this and we.
If you don't need the rental income,
Right.
then we don't care. Yeah. For non-subject properties, like let's say they have you know, their owner occupied house is not the subject property, you're financing another property, and they have a rental basement. If you need that rental income and they declare it on their T1 generals, we will accept it for non-subject property. So not the property we're financing, as long as it's declared on their T1 general. So we will allow that. So we're still pretty flexible. Like I said, Varan has the solutions and he'll know where to direct that deal.
You know, the loopholes.
I think so.
No, loophole, it's a policy.
We're looking for the loophole.
Question on there, Brandon?
Yeah. The other question we got is how stringent are the rules for self-employed purchases and refinance?
So I'll take the liberty to define stringent. So our self-employed policies are pretty straightforward. Do we do gross up for incorporated folks? We don't. So I know some banks will use net income after taxes. We don't have these programs in the broker channel yet. These are programs that we are developing on the back end and will eventually have them available. For now, if you need to gross up the income, we cannot do it for incorporation, but we can still stack our policies, and I'll clarify that point. So I'm looking at the camera. Yeah. So I'll clarify that. That means, let's say you have a self-employed customer, your ratios are at like 60% because you know they don't declare much, but they have a good amount of assets to cover what our program requirement is. We can actually qualify the deal using both programs, so our self-employed using the average of 2 years and the net worth program to help the customer qualify with us. So our programs are stackable, so we can do multiple programs to help a customer qualify within all of our policies. Does that answer?
To RMB.
Up to what loan
Someone
value? Sorry, sorry. Up to what loan value?
80%. Yeah. Our net worth is we can finance up to 80% of our net worth programs, regardless of your TDS.
Yeah,
So you have 10,000
That
of it.
case might be like 200.
Yeah.
But you're validating it with the works.
Any other questions?
Down payment, you touched on earlier.
Pardon me?
You touched on borrowed down payment or forced down payment
Yes.
to be borrowed.
Yes.
Okay.
Yeah, I mean, let's talk about an insured deal just for our example. On an insured deal, the only requirement we have is the customer has 5% from their own savings. They can borrow the other 10% to make it 15% if they want to have a lower amount to try to qualify and to have a smaller premium to pay with the insurer. Yeah.
And borrowed from a loan from the bank or?
Yeah, so if let's say you have a line of credit that is unused, you can take technically money out of there to put your down payment.
But the down payment, the 5%, you'd want to see sitting in the bank for 90 days.
90 days. That's the only thing we'd want. Yeah. So the rest could be borrowed. They can have the room on their line of credit. We're just gonna factor in that line of credit in the ratios, right? Because we're gonna assume that that it's all gonna be used to borrow the down payment. Yeah.
So the first time buyers will have the ability to take out against if they have RSPs or set up an RSP and borrow that fund, whatever that money towards a purchase.
Sorry, repeat that question.
I think it's first time buyers.
Yeah.
The ability, if they don't have the down payment required, whether they've got a savings, RSP savings, or they need to start one in order to take advantage of that
Yeah,
government program.
yeah. So that's actually a good example. So let's say you took an RSP loan, right, to get your RSPs, to get your tax return, get some extra cash in your pocket. And then you're going to use that RSP loan, sorry, that RSP as a down payment. Technically, it's borrowed fund because you still have a loan that's, that you have attached to it. So you can actually use the tax return you're going to get from your contribution, pay off part of the loan because you won't have enough contribution to pay off the whole loan. So you can use that, and then, you'll continue paying the loan, but you'll have the RSPs ready for you to use as a down payment for your purchase. That would be borrowed. That's going to affect your TDS because we have to factor in the payment of money. Correct.
That's
Yeah.
if you're borrowing new money for your RSP.
Yes.
Now, you've got money, is that the same?
No. So if you have money in the RSPs, you're a first-time home buyer. There's no hold back on it, right? I think it's up to 60,000 per purchase that they can withdraw for the home buyers plan. So 30,000 per person, I believe. So don't quote me on that. I haven't done direct sales in a while, but yeah. So that would not be borrowed money. We just see that they have money in the RSPs that they couldn't withdraw. Money has to sit 90 days in the RSP so before it can be withdrawn for the home buyers plan. Yeah, that's for first-time home buyer or first-time home buyer after 5 years. So let's say you sold your house 5 years later, you would still qualify if you rented for 5 years or live with, let's say, with family, you would qualify as a first-time home buyers if you haven't owned a home within 5 years, during that 5-year period.
Whatever funds you withdraw from your RSP account that's taxed about, not complaining that you pay taxes on it.
So for the home buyers plan, once you withdraw the money from your RSPs, you have 15 years to pay it back, to pay yourself back, essentially. So it's like an interest-free loan for yourself on 15 years. So you can contribute 1/15 a year towards your repaying your home buyers plan. So that contribution is not going to have a tax return. Yeah.
If I was pulling it out for my own use other than real estate or whatever.
Then you have taxes up front. Yeah. But there's different government programs that allow withdrawal from RSPs. I think investment in a business, education, stuff like that. There's flexibility with RSPs. Any other questions?
The rate for GDS and TDS.
Insured is 39.44, so that one is standard. Conventional so BMO is 40.45. Now, can we do exceptions? We can do exceptions based on the customer situations, but we won't go over 50 of TDS and we won't go over 45 of GDS. But again, anything above the threshold on the conventional 40-45 has to have an exception. And what are the typical exceptions? No, stop it. What are the justifications to the exceptions?
Fallback assets.
Fallback assets. So, fallback assets. So any type of assets that the customer has, we're going to consider that in the whole analysis of the deal. Let's say customers have bonus that we haven't included or overtime that we haven't included. These are all good justifications to an exception to TDS or GDS. Good.
Thank you, Nick.
Thank you, guys. Very nice to meet you.
I sent your contact info to the WhatsApp group.
Cool.
Okay, so we have another presenter, but no big presentation, but I didn't get your thing yet. It's okay, I'll pop it up at the end. Okay, so we have another speaker. It's Kelly. I have it up here on my thing. We got Kelly from RFA Mortgages. That's what it was. So I'll let you just kind of present. Some people have questions.
Okay.
We just ask that you repeat them for our online audiences.
Absolutely. No worries.
With no pressure. It's fine. I'll post it up. Otherwise,
Just to give a gist of it, Kelly's RFA, not a traditional bank. They look opposite of what the bank is.
Yes.
Yeah, sorry, Brian, come
It's okay.
tell the audience.
So Kelly's from RFA. RFA is a non-traditional bank lender, so they are considered as a B lender or
Alternative.
alternative lender.
Yes.
So someone asked a question about the self-employed.
Yep. I'm gonna go through all of that.
She'll be probably the best person to talk about the options. Thank you,
Thank you. Thank you, Varian. So first I'm gonna apologize to all of you guys because I'm much louder than you. Okay, naturally. I don't do a presentation where I'm going to just go over like, the nitty-gritties of the product. I do hold my presentations more of an open forum conversation. So I encourage anybody to ask questions at any time throughout. The alternative space is a very gray space. Okay. It's pretty much essentially anybody who doesn't fall within the banks. Okay. So there's nothing that I can present to you guys that's going to go through everything that we can possibly do on the alternative side. So I touch on what I think are the highlights. If you guys have any questions, please put them in the chat, put your hand up, and I'll make sure to touch on any question that you guys may have. So, what's wrong?
I can hear it echoing.
Is it echoing?
Not you, someone on Google. No? Keep going.
Is it echoing? Can everybody,
From you.
Oh, sorry.
is it you?
Is it because you turned this off?
Can everybody hear me?
We can hear you twice.
Oh, God.
Our text.
Hold on, we're just having a technical issue for the ones online.
Turn it off.
We're old.
Yeah, you can turn off that computer. You're not gonna do it.
Was he echoing?
Or were you
Try that.
connected to the phone?
I think it's some, yeah, yeah, you can go.
I hear fine. So people online are saying I hear fine now.
Perfect.
I'm not
It's just
echoing.
us.
Okay, good. Okay. So first and foremost, I think one of the things that I'd like to obviously address right now is there's a lot of talk in the market. Market's been difficult for years. And I think what a lot of people don't understand is the lenders, especially alternative, I'm not going to speak to the banks. Obviously, you have your bank expert here. You can talk to him. We're doing everything we can to try and help move the market. Okay. We are trying to think of very creative solutions to help clients either, refinance, in a lot of cases right now, keep their home, or purchase their first home or second, third, fourth home. So I think it's imperative that everybody ask the right questions. I think it's imperative that you guys lean on Fidus, the brokerage that you guys have. They specifically have a great relationship with the lenders, which means if you guys have a potential client on the phone, just a general inquiry and you're really unsure, ask them. Ask them right away. They have all of us lenders at the tip of their fingers. Okay. Which means he can literally call me and I will normally return his call within a half an hour to an hour, meaning you guys can get that client an answer. It's a standout feature for you. Okay. Work with the brokers that you know, the ones that have great relationships with lenders, because ultimately it's going to help your client feel more comfortable with whatever question they had, proceeding with the purchase, etc. So with that being said, in the last week, there has been some movement. I know BMO spoke to the cost of funds. There has been some movement on the rates. Okay. I don't know what the banks are doing, but I do know the alternatives have dropped the rates recently. Okay. What that means is everybody thinks alternative is very expensive. Our 3-year rate right now is 509. We're not far off from a bank,
That's your B lender, right?
but we're a B lender.
Not the private.
We're B, we're not private. Okay, so we still have to qualify our deals. We're still OSFI regulated. Okay, the pain in our butt. So that's just to put into perspective. I mean, Baron could kind of speak. What are the bank's rates right now? They're in the fives.
Some of them are fours to
High fours, right? So we're the alternative lender, which means we have different solutions. We have a higher risk tolerance for clients, and our 3-year rate is as low as a 509 right now. So we're not far off from the banks. This is us trying to help the market move here. Okay, we're trying to incentivize clients to not be afraid to refinance, to buy, to sell, whatever it is that they need to do. Okay. Another thing that we have is 35-year amortization. Okay, this is a product that there's only 2 alternative lenders who are offering 35-year amortization. This gives clients extra buying power. First and foremost, if they want to buy a house, it gives them the ability to possibly increase their purchase tolerance by $50,000, maybe more, depending on what the purchase price is. This also gives the clients the ability to go higher ratios. because 35-year AM is going to help with our ratios on a deal. Okay, and I'm going to get into the ratios of it, but I'm just trying to emphasize to you guys what the difference is with the alternatives versus the banks. Banks are typically 25 on an insured, and I think they go up to 30. Well, we'll consider up to 35. Okay. Another thing, the rental market right now. There is a lot of questions on the rental market. If lenders are going up to 80% on condos specifically. I'm going to guess that there's a flood of them on the market right now where they're not moving. We have not scaled back our appetite, which means we are still considering 80% on rental condos. Obviously, this is always subject to a full review of the client, the portfolio, the credit, the ratios, and stuff like that. But 80% for us on a condo is not something that we're shying away from at all. While majority of the alternative lenders have scaled back to 75, we're still being extremely aggressive. Okay. We know 3 years ago, people built up their portfolio. Okay. They ran and bought 5 condos because the rental market was through the roof. Unseen prices, rental prices. So we're not trying to penalize them for making a decision 5 years ago. We are still considering those today. Okay.
It's still the regular qualifying and so on and so forth.
On the alternative side, we must qualify everything.
That's the same as the A side.
Yes, this is an OSFI thing. Okay, so everybody knows about the news about TD, their $9 billion lawsuit. Nobody's unaware of that. With TD and CIBC going through that level of AML defiance, I'm going to call it, there's an extra level of scrutiny on lenders right now. Okay, so I'm going to go through some of the things, and I want you guys to understand we're not trying to be difficult when we ask questions. We're trying to ensure that we are adhering to the anti-money laundering because of everything that's been on in the media right now. We have to do our due diligence. So everything must be qualified. Privates are the only ones who don't qualify. Okay, higher rates.
How about fees? Fee lender fees?
So we do have fees. We have a standard 1% commitment fee. What I normally tell everybody is when a client is in the alternative space, it's because they don't fit within the banks. Okay. They don't fit within any program that the bank has to offer. So if they are coming to the alternative space, they kind of have to pick their poison. They're either rate sensitive or they're fee sensitive. So our standard deals come with a 1% fee. However, we do have the ability to increase a fee and pay and get the rate down instead. So just for an example, 1 year is at 5.29 right now, 1 year mortgage. And the client says, no way, I'm not paying 5% on my mortgage. Absolutely unacceptable. I need to see it in the low 4s. Well, we say, okay, we'll charge you a 2% commitment fee and we'll get that rate down to 4.29. That's going to help them with the monthly cash flow. Okay. And essentially, the banks are a little bit different, but when it comes to the alternative side, I've been doing this a very long time. There is nobody right now who's looking to pay off the mortgage. Okay. The only thing people are looking for is to keep a roof over their head, food on the table, and clothes on their kids' back. So I often say that's a long-term plan for alternative clients to pay off that mortgage, get into the bank, and then really focus on prepaying that mortgage. The alternative is a solution. We are a short-term solution. No client should ever want to, unless they're BFS, stay on the alternative side for the long period of time. So we can increase that 2% fee. It gets tacked onto their mortgage for the most part, and we get their rate down to 4%, which is going to offer them $500-600 a month savings. Another thing is that we have a lot of deals where ratios we can go up to 60-60, and I'm going to get into that, but we have a lot of deals where our ratios are right at the cusp. So clients only have 20% down. They bought this property and their income comes in slightly less than what we all anticipated. And our ratios are at that point where it's like, oh, dear Lord, we have to cut their loan amount, which we don't want to do on a client's purchase at the end of the day. So what we can do, increase the commitment fee, get that rate down by 1%, thus still allowing them to buy that purchase price that they had at the commitment fee to the mortgage, as long as it does not exceed 80% loan to value. Yeah. There's a lot of creativity on the alternative side, documentation wise.
Fee lender and fee lender.
Mhm.
So why would somebody then needs to qualify with a name, go to a B, if the same rules exist?
So it doesn't. So the question, sorry, in case I'm not sure if I online can hear, the question is, why would somebody come to the alternative side if they can go to the A side? Because we all have to qualify. The reality is that the A side has different parameters. Like he spoke about, his ratios are 39-44. Okay. We can go up to 60-60.
These are part of the government umbrella or whoever oversees you guys.
OSFI is the regulator of all lenders. Okay. They're the ones that come in and crush us with their new requirements and saying, this is what you have to do. OSFI will say, you tell us what your comfort level is. As a lender, what is your comfort? So we present, we are comfortable going up to 60-60. So they're there to ensure that we adhere to that. There is no alternative lender that goes above 60, okay? On a conforming loan, meaning we are still considering up to 80% loan to value at ratios of 60-60, where the banks would be 80% loan to value with ratios of 39-44. That means on the alternative side, so if you have a client who says, I really want to buy that house, it's a little bit over my budget, it's 900,000, we really only wanted to spend 700,000. FIDUS is going to look at that application and they're going to say they don't fit within the bank. Their ratios are too high. The ratios are 57-58. That's an alternative deal. Okay. So instead of the client deciding that they have to drop their purchase price by 200,000 and maybe go into another town or city that they never wanted to be in just to stay within, they have the alternative space as an option.
But a TDS, GDS is not enforced, whether it's on A or B.
TDS and GDS is enforced.
They are.
Absolutely enforced.
That's the rate that's set. Like you said, 39-40, you guys go up to 60.
So those are the rate, that's the parameters of the clientele that we're looking for. So the banks want 39-44 ratios, while the alternative can go up to 60-60 ratios. Higher risk deals on the alternative side. The banks look for, I hate the terminology, but they're looking for the more cookie cutter, clean deals, low ratios, low risk, where the alternative is taking on the higher risk. Okay, going up to 60-60 does show that the clients have the ability to default. But this is why we're in this space and the banks are in theirs. Make sense?
I think once it goes through the how they qualify the income and
Yeah.
the other aspect, you understand why the alternative could be an option.
Yes. Okay. So I'm going to actually talk about ratios. So our standard ratios are 50-50. That is the best deal to us. Client who has 50 TDS, 50 GDS poses absolutely no risk on our deals. We do have the ability to go up to 60-60. Okay. What that means is, first and foremost, gives your clients more buying power. And that's where the conversation that you have with your clients upfront and knowing what is out there, what solutions are out there, you guys can have more accurate conversations with your clients. Okay. I don't know if you guys put applications together, but I do know if it doesn't sound right, I encourage you guys to reach out to them. They'll plug in some numbers quickly and determine what the client's affordability is on that, knowing that they have lenders that will go up to 60-60 on a deal. Okay. Beacon scores. So the banks like their 680 client beacon scores. They want stronger profiles. Our minimum beacon score is 500. Okay. So if you guys have a client who's had some life events or just overall hasn't been very responsible with their credit, missed some credit card payments, didn't really see the impact of it, and they're looking for a purchase, they want to buy, because a lot of clients with bad credit still want to buy. It's credible. That's when those deals will come to us. A client with the 501 beacon score buying in the GTA at 80% loan to value is something that we will still consider, although they pose a high risk. Okay. We can do below 500. We just have to scale back loan to value. Okay. Because below 500, there's normally a lot of arrears noted across their credit bureau. They've pretty much stopped paying everybody at that point, but there is still a solution on the alternative side for them. It's just, we have to reduce our risk by what we can lend to them. Yep. We can consider on the alternative side, we will consider clients who are in consumer proposal, clients who have been bankrupt. There is no threshold for the bankruptcy, meaning if the clients went bankrupt last year and officially got discharged a month ago, because it's going to show that they got discharged, we can consider financing them today.
So they need.
On a bankruptcy, they have to be discharged. You cannot pay out a bankruptcy. Okay. A lender can't pay out a bankruptcy. No lender can. They have to pay it out. But we just have no threshold as to how long they have to be fully discharged from bankruptcy. We can consider it as quick as 2 weeks after being discharged. This is where the risk appetite comes in. Sorry? They haven't, well, technically they normally don't, right? But we're going to look at their profile and see what they look like. We can pay out CRA arrears, clients owe property tax arrears, Canada Revenue Agency. We can pay out credit card debts. We can pay out anything, actually anything but a bankruptcy. That's the only thing that needs to be discharged before we can approve the loan. Okay?
How's that payout take place? Where's it going from?
A payout would be on a refinance, which you guys wouldn't normally deal with. A payout would be on a refinance, or if, for an example, the clients are currently looking to buy, if they have all of those, if they have property tax arrears, CRA arrears, and they have the ability to pay it out, or the buying and selling, whatever the case may be, it's something we'll still consider. We don't shy away from those clients because they decided to stop paying those, I call them creditors at the end of the day. They are, right? So we'll still consider those clients. Okay. Is there any questions online so far? No? Okay. So next is going to be our BFS income, our business for self income. This is what I think a lot of the alternatives specialize in, especially RFA. Okay. So on the bank side, you can correct me if I'm wrong, they more want, the confirmed business for self income by T1s, NOAs, financials, whatever the case may be. They do have stated programs, but I think it's a little bit different. Our stated income program for BFS clients mean we do not want a tax document on our files. I do not want to see what the client claims to the CRA because we understand that the clients pay accountants very good money to drive that business income as low as it can possibly be. Okay. I wouldn't want to pay an accountant and still have to pay the CRA $400,000 worth of income tax. So what we do is we drive our income off of the business bank statements. In the industry, typically people want to see clients have been business for self for either a year, 2 years as the standard. We only want 6 months, which means if a client decided that he was going to incorporate or become a sole prop as little as 6 months ago, I can consider those clients. What I don't want to see, and this is my example I use every single time, I do not want to see someone who's been a chef for 10 years who decided to become a plumber 6 months ago. Okay. Because from the lender standpoint, it's funny, right? I thought so too. From the lender standpoint, there's a sustainability of the income issue. Okay. How do we know he's really going to continue to make the money that he's been making? So if you have, for an example, someone who's been in the trades for 4 years, working for a union, hates his foreman, has enough clientele and says, you know what, I'm done with this. I'm going on my own. I'm incorporating or opening up a master business license. And that was 6 months ago. We can consider that. We use the income driven from the bank statements, not what they declare to the government. Okay. That is a huge advantage in the alternative space because that gives your clients more buying power. We no longer care what they've declared on their NOAs. We don't want to know what they've declared on their NOAs. I want to see what his true income is. And that's going to be driven by the bank statements. We have clients who are very successful business owners. I'll give you an example right now. I have a truck driver. Okay. Been a truck driver for 21 years. He has 157 employees and he makes $21 million a year. His NOA has him at less than $60,000. Okay. That's creative accounting. Okay. That is the most brilliant accountant I've ever seen in my life. Point being, I don't care about the NOA. I'm looking at the bank statements and I'm going to see annualized $11 million coming in the last 6 months, minus the expenses. We do have to take into account every business has expenses. Okay. So we do have to minus what the costs are of running that business by the bank statements. So if you see a client, he's paying rent or he's paying employees, those do need to be accounted for. But we are basically stating the income on the deal. In this $21 million case, the client needed to state, I think it was $600,000, and the bank statement supported all day long. So this is another thing that you guys need to know, because when you're talking to your clients and you're understanding how they work or how their business works, you can understand what their buying power is. Okay. You're not going to have a conversation with a client and saying, oh, your business for self, darn, what did you declare? And he says $40,000. And you're like, oh, I can't find you a house. What am I going to find you a house at 400? Now you know the alternative space is going to be, oh shit, now we're going to get $500,000 worth of income. Okay.
Game-
It's a game changer on the alternative space.
Basically, stated income has to be backed out with banks.
Stated income always needs to be backed up with bank statements.
$100,000. Oh, okay, I think you're here.
Oh, the napkin days? No, those were gone in 2012 when we used to be able to state it on a piece of paper. Yeah, those were the best years of my life as a lender. Huh?
Oh.
Oh, that was so exciting. We used to literally be able to satisfy income. It would one piece of paper, I state 100K, income used to be satisfied. 2012, I think it was. Yeah, 2012, I think. Yeah, that's when OSFI had no control. They've taken the reins in on the lenders a lot. They've implemented a lot of things. So those days are gone. They're good memories I have, but they no longer exist. So, but the point is the bank statements will support the income that the clients need. Okay. And if you're ever unsure, guys, if you guys are ever working with a client, get the bank statements up front. Just ask them. Okay. Run it through one of the agents saying, here's what they have. What do you think you can get? This way you guys can gauge what buying power do these clients have? Okay. And you know where to position them, what city they're going to, what kind of property. Are they going to condo or now they're going to fully detached in Toronto? It's a make or break when it comes to the BFS. Okay. So that's huge for the alternative space.
You want to mention how you qualify the realtors?
With the realtors. So we have two options. Is it very different from, okay, I'm,
T4.
you could speak.
You look at the T4 income versus what they filed on.
Yeah. Okay. So the banks don't?
They look at the T1 and then.
See. Anyways, on the alternative side, for realtors, we actually, I didn't realize it was aggressive. So thank you for adding that. We look at their T4As, T4AEs. There's two ways of doing it. If a realtor is incorporated, we can actually go by 12 months bank statements. Again, driving a stated income deal on a realtor. If they're not incorporated, we'll go by a 2-year T4AE average. What we're looking for is year-over-year growth. Obviously, if they made, for an example, 200,000 last year, or in 2023, in 2024, that we want to see that they're at 200 or just above. That's how we drive the income. Again, not declared to the government. I don't think on the alternative side, there is any form of income that we want to see that is declared to the government. Okay. It is all by the documentation supported by the employer or business for self people. Full-time, we're very simple. Pay stub job letter. That's it. That's all we really require. We use the gross income. We take nothing else into account. We use the gross income of what they use. Child tax benefit on the alternative side. So child tax benefit is huge. People are living off it now. At the end of the day, it's what's carrying a lot of people. We can use up to 100% of child tax benefit. And on the alternative side, we can use it for a kid who's literally 17 years old and 11 months. So child tax benefit stops at 18 years old. Okay. Government rule, doesn't matter at what point throughout the year, the child turns 18, government cuts it off the moment they turn 18. If we had a deal where the clients are like on a 3-year term, 3 years, their kid at the time of approval and funding was 17 years old and 11 months. We know the child tax benefit is stopping in 4 weeks from the date we fund. Doesn't matter. At the time of funding, we can use a child tax benefit. Again, adding more buying power for your client. Child tax benefit isn't typically $100, $200. For what we see on the alternative space, again, a lot of business for self people. Okay, we're driving their income as little as possible. Child tax benefit can be $600, $700, $800 a month.
You use OAS too.
OAS, we can absolutely OAS, CPP. Yeah, I didn't realize. No, I feel a little bit better about the alternative space. We use all forms of income, disability income. I'm gonna say it now just because I actually had one just before I walked into here. We do not use welfare. Okay, I had one. They're on welfare. I'm like, people on welfare should not be allowed to buy a house right now. So that's pretty much the only income we will not use, which is welfare. Okay, anything else we can reasonably use. Okay. Any other questions so far? No? Okay. Contributory income. This is huge for us. We are the only alternative lender who will allow for contributory income to be used on an application. For those who don't know what contributory income is, it is from someone who resides at the property or who is going to reside at the property, who contributes monthly to the household expenses. We can use up to, I think it's just shy of $15,000 of their income. So I'm going to put that into perspective as an example. You have mom and pop who own a house. They're selling it. They're downsizing, buying a new house, but they had an adult son living with them. Okay. We know that the children can't get out of the house anymore. In their 20s, they're in their 30s, still living with parents. If we have proof that the son lived there, we can use $1,200 a month of his income and plug it into our deal to help, which means on a deal, the hairiest of hairiest deals on the alternative space, 80% loan to value. Okay. We have 35-year amortization because the ratios were so tight. We have the max ratios on the deal and contributory income. That would be the equivalent of us approving up to like 80 TDS GDS on a deal. So that can be the difference if your client's getting an extra 50, 100, even possibly $200,000 on a deal. Okay. We are the only ones who allow for this. Every other lender will speak to it, meaning they make a note of it. You cannot plug it in. You cannot use it to help your servicing on your deals. We will use that to help the clients. Okay. That can be from any immediate family member. I used son as an example or child as an example. It's any immediate family member. I'm going to go through the definition of what an immediate family member is because I think people seem to think it's mom, pop, brother, sister. It's not. An immediate family member would be, I have the note somewhere. It is, for an example, mom, pop, brother, sister, brother-in-law, sister-in-law, parent-in-law, grandparent, legal guardian, cousin, niece, nephew, uncle, aunt, anything like that. It's a very broad definition. So don't ever think that it has to be immediate to their household. Well, if the dog, monkey, we might have a problem identifying them because we do have to identify our clients for AML purposes. So let's keep that one out. But yes, the list is huge.
Now, these potential deals have to be brought forward to you by a mortgage broker, and
Correct.
I cannot come and
No,
fill up an application.
no. So at RFA, we won't work direct with clients. We have relationships with our brokers and our brokerages. We are also very selective on who we work with. Okay. We are not open to the entire brokerage industry out there. Only select trustworthy people that we have good relationships with are the ones we'll work with. A client can't come to us and apply for a loan direct. Well, in all honesty, I come from other lenders where they did have direct client services. I'll be very honest with you. Maybe 1 out of 50 applications ever got to funding. Clients don't understand the lending world, nor do we expect them to. Okay. So you may ask a client a question, and they answer you with something else. And normally they open up cans of worms that we don't want to know on the alternative space, where if you guys have a question and Baron calls me, him and I are going to have a very open conversation. We are going to structure that deal to the best of our ability. But we also know what not to disclose. Okay. We know not to disclose what their NOAs are because we know that that will hinder our deal. Where clients would be like, oh my God, my NOA says $26,000, but I make 500. Well, your deal's dead. I've been doing this a very long time. I've seen it all. Okay.
You're upper med.
My title is regional vice president. I'm a BDM. Okay. I've been in the alt space my entire career, and I'm not going to age myself here, but we're talking about 15 years plus. I've been in the alt space, so I've seen a lot of the changes. I know what we could have done, what we can do. I've never been on the bank side. Don't take offense to this. I find it very boring because the alternative side is very creative. Okay, we have solution-based mentality, so we're always looking at how we can provide a solution for the clients. Okay. Any questions? Sorry. I have not worked with Benson Mortgages, but I do know them. I see that question in there. Rental income. So we are on a subject property, 90% add back. It's industry standard for the alternative side, which means the only difference with the alternative versus the bank, we do not need it to be legal. The only thing we need is it to be self-contained, meaning separate entrance, bedroom, bathroom, kitchen. If there is no separate entrance, there is the possibility of an exception. What I need to understand is the relationship. Because I myself as a tenant, if I'm truly paying $2,500 to rent someone's basement and I have to go through their front door, past their family room to get to my staircase, the average person doesn't want strangers walking through their house or tenants. So I just want to understand the relationship there. It could be that the person renting is a child or, someone attending university of a very good family friend. Okay, they've been family friends. So there's a comfort there with the person walking through their house. So those are exceptions, but this is an example of what we would consider. Typically, we want self-contained units.
Sorry, what do you want for the proof of
If it's a subject property, we need to market rents on the appraisal.
no, for example, family, friend, how do everybody.
It's a story. It's just the story. At the end of the day, the alternative side is telling a story. I tell everybody I could sell any story to Walt Disney World at this point. There's always a story with an alternative client. If they were a cookie cutter, perfect client, they're going to fit within the bank's parameters. So once they're on the alternative side, it always comes with a story. If they have bad credit, if they have somebody who lives with them that is a personal person, not a self-contained unit, there's something that triggers them to be on the alternative side. And it is up to both you guys and the mortgage brokers working on that deal to get the story of what's going on with that client. Okay. Good. Okay. One of the things that I want to talk about is penalties. And I know typically you guys probably wouldn't care about the penalties, but I want you guys to know is if a client is placed with RFA on the alternative side because their credit was bad and they just couldn't meet the bank's requirements, they bought a house, they had to come to the alternative side. I want it to be understood that we have industry-leading penalties. This means the client can break the mortgage at any point throughout the term. There is no bona fide sale clause. We are not locking this client into the term. They have the ability, if they break within the first year, which I don't encourage, okay, it's 2% of outstanding mortgage amount. If they break after the 12 months, it's 1%. That's it. Okay. It's industry leading. Everybody else is 3 months interest or IRD, which is very expensive for a client. We are very, very common sense. It's actually something that they don't want me promoting. I talk about it all the time. Because they don't want the clients breaking the mortgage at the end of the day. We also have the ability during the term. So let's say we put a client on a 3-year term. Okay, it was the lowest rate. It worked for the client. Life happens. And the client says, I need to break that mortgage. I can't afford it anymore. I need to sell that property. I'm downsizing and buying a condo instead. If they bring that new deal over to RFA, we will look to waive their penalty on their existing mortgage. Okay. If the client somehow within that 3-year term suddenly qualify for the bank and, they identify it and saying, wow, their credit's really, really improved. They have the standards now to meet the bank's requirements. We also have the ability to take them from the alternative side and graduate them over to our A side because we have both at RFA. We have an A side and a B side.
Who's your ace?
RFA Prime. I'm not the BDM. Please don't ask me any questions about A. But we do have the ability to graduate them over to the A midterm. Okay, so they don't have to ride out their full 3-year term on the alternative side with a penalty if they're graduating. If they're breaking it and bringing it back to the outside, we will look to waive the penalty.
Wait, so there's still a penalty if you graduate?
If you graduate, yeah, you're breaking a B to an A, right? So depending on when they break, right? So again, but let's just say a client has a $500,000 mortgage. I'm going to keep it simple. They break in 18 months into a 3-year term. Their penalty is $5,000. But now they're catching an A rate with the bank for another 1.5 years. That offsets itself very quickly, very quickly.
if the house is grown in equity, are they able to take some of that equity out?
Absolutely. So if the clients are looking to refinance at any point throughout their term, we can break the existing mortgage. Let's say they've, life happened and they had to send a kid to university. They want to buy a car, or they just lost their employment and utilized a lot of credit to sustain themselves during that time. We will absolutely look to break the mortgage, refinance them, reconsolidate them, get them into a better position again. And those are the ones that we'll definitely look to waive the penalty, either partial or full. We try our hardest to do full, but with the rates coming down now, I've seen one of them that was a partial refund instead.
Sorry, dude, she just seems so much more helpful.
We're creative. Hey, at the end of the day, the bank's where you want to be. But start off with the alternative side. It'd be greatly appreciated. Thanks. Another thing, we do deals up to $4 million. Okay, with exceptions up to 5. So we're not shying away for those large properties, which I know are posing a risk in the industry right now. First of all, they're harder to sell. Second of all, they're harder to find a lender who has an appetite for them. We're still considering those. Okay.
Turnaround time is still typically 5 business days.
No, our turnaround time is 48 hours. Yep. We're very big on service at RFM. Okay. We staff accordingly for it. Our turnaround time is 48 hours. If Varen ever called me because you guys have a client and you need to rush, and he said, Kelly, I really need a favor, I'm going to call it in based on our relationship. I'm going to call in the manager and say, I really need this one put on the front of the list. We have better control because we're a smaller group. We don't do pre-approvals. We do not do pre-approval. Pre-approvals are worth the piece of paper that they're written on. Always best to put a condition in. 5 years ago, I would have said conditions don't exist. In today's world, I would absolutely say to put a condition in. And I say 5 days just to be safe, right? However, we don't underwrite to condition of financings, which means if your client has a condition of financing because they want to see if they can get approved for a loan, that's fine. We're at a 2-day turnaround time, 48 hours. But I will not review those documents and satisfy all those conditions until we have a live deal. The alternative space, you guys have to understand, the alternative space is volatile. There are a lot of changes. The deal I get in today will literally be re-underwritten and restructured anywhere from 5 to 100 times by the time it gets to funding. Appraisals will come in light. Market rents doesn't come in as expected. Income might fluctuate. Client told you are full-time. That's great. We get confirmation that they're actually part-time, and now it changes the deal. So we will not ever give you a file complete until we've had all documents on file on the alternative space.
So when we're up against a bidding war, which is still quite common in cities.
We'll give you an approval, but we can't give you a
based
file
on
based on your client giving us accurate information.
right,
You
more or less what the bank is giving you a pre-approval with 15, 20 conditions in there.
think the bank's pre-approval has a very long term on it. Am I not mistaken on that? A long term, like a guaranteed, isn't it a year?
It's a rate commitment.
A what?
Not the rate commitment. A pre-approval for a mortgage. Your
So based
pre-appro-
on what the broker sends us,
Right,
right, we're gonna approve it based on the information presented. The more accurate, the closer to reality. If they're not accurate in the information and then they submit a deal and
no, of
to
course.
her
you
point,
catch a
it's
mistake,
part-time,
whatever.
not
Yeah.
full-time. Like all these things, obviously kind of invalidates the initial.
So it comes down to the broker, what the broker, it's come down to the broker.
What's been submitted is.
Okay. If the
Correct.
broker knows what they're doing,
Correct.
you will be fine. You
So I
fix
guess-
the condition.
We don't identify it as a pre-approval because it's never one, it's an actual formal commitment. Here's our commitment. We are committing to funding this deal for you. Clients have to sign it back, and we set out all of the requirements that we need. We're going to fund this deal for you guys if you guys can meet this, and that, right? I'm going to give you guys an example, especially from the alternative side. I know you guys have a lot of conversations. I'm going to guess that when the clients are buying a house, you talk about down payment, right? And you say, where's down payment coming from? Oh yeah, no, I have the down payments, personal funds. Okay. You don't really think to elaborate on that. And I'm going to say on the alternative side, and this is actually, there's a huge uptick to this in the last 120 days for us. We'll get bank statements. It'll show that they had the money. What nobody identified is that there was a wire that came in just before that. Okay. So that's not the client's own funds. For anti-money laundering purposes, we now need to trace that wire. We need to ensure it's not coming in from a sanctioned country. If any of you guys are unsure of what's sanctioned, you can literally just Google Canada sanctioned countries and the list comes up. If it is from a sanctioned country, the deal's dead. We can't accept it. We don't care that the bank accepted it. We don't trust that the bank accepted it. Sorry, like, pardon? No, but for an example, Russia's.
Now you got.
Hey, listen, US might be soon, but for an example, Russia, okay? Russia's on that list. If we tie that wire back to Russia, we can't do the deal. Our deal's dead because it's an anti-money laundering thing for us. It's a sanctioned country. We shouldn't have accepted the funds from Russia to begin with, so we can't do our deal.
Why you offer deals now and going down.
That's why we offer deals in Thornton.
That's why they're-
Well, there's right now, I'm gonna say, the guys, in the last 120 days, there are so many wires. There are bank statements that are coming in, and this is a part of the moving part on the alternative space. I don't think that the questions were asked up front properly. You don't take what the client says at face value and just assume that, yeah, the money's been sitting there. Ask the question, is it your own money? Is it accumulated savings? Did you get a gift? On the alternative side, we will allow for 100% gifted funds. Okay? The client doesn't have to have any skin in the game. If mom and pop want to help out their kids, we're buying their first house and they want to give them the full 20% loan to value, down payment, we're fine with that. The only thing to note is that if you know there's going to be a gift, you have to ask the right questions. For AML reasons, if it's over $100,000, we must trace it. Okay? I understand a lot of people say, well, TD accepted it. Well, first of all, TD is not a good example these days, but TD accepted it. That doesn't make us as a lender skip that step. TD accepted it. That's on them. A year ago, we could have said we're relying on TD's AML process. They accepted the funds. They would have had to meet the AML requirements of Canada. We can piggyback on that. With what's going on and TD and CIBC being in the news in a negative light, we have to adhere to our own anti-money laundering, which means I need to source everything now. So you have to understand, if a gift is over $100,000, we do have to get the giftor's information, which means if mom and pop are gifting their kids $200,000 to buy this house, we're going to ask for mom and pops, if they were pulling it out of savings account, we need 3 months of their bank statements. We need to ensure for anti-money laundering that mom and pop are not the middlemen. So we get their bank statements. We're going to see they either have an accumulated funds and then just cut the check, or we're going to see, for an example, that mom and pop have large deposits or wires coming in their account. That's what we're looking for as a lender. That's what we have to do to adhere to anti-money laundering. So ask the questions. I have a template that I've put up of just basically the questions that you should be asking any client upfront on any conversation that you're having. You can kind of check off what you know the lenders are going to need at the end of the day. If you guys go, I'll share that with you. I have no problem sharing that with you. But if you guys have those answers, it makes the ease of process, that makes your commitment pretty much bulletproof. Okay, so you don't have to worry about a pre-approval because you have all the information that you need. You know that the deal you're putting in is going to be a solid deal for your clients. Okay. Sorry, there's a question here. What are your geographic restrictions considering $4 million deals? Geographically, the $4 million deals typically are in the GTA. That's just the pockets of them. However, I always tell everybody, if there's any large property value anywhere, you send me an email saying, Kelly, would you lend on this? And I'll say yes or no. But obviously those high ticket properties, they're not in tiny township. They don't exist in tiny township. So they're more GTA major locations when it comes to Ontario. Okay. I would not be looking for a $4 million property in Newfoundland. I'll be very honest with you guys. That would be like the white elephant in the entire subdivision. Okay. Hope that answers your question. That's all I wanted to go through. So I hope you guys found it informative. If you guys have any questions, please. Yeah, go ahead.
It's going to be a weird question, but
Nothing's weird.
let's just say someone comes to me and says, hey, in the alternative world,
Yep.
I default, I'm not paying my mortgage payments, I'm having a hard time. How much time do I have to sell them?
Depends on the lender.
They're all depend on one.
It does depend on the lender. I'm gonna say probably 60 days. 60 days and lawyers are involved already.
Is it the
Possibly at
same
30.
Same process.
Are you guys 60? I'm gonna say some alternative lenders might be at 30. 30 and they're getting lent, so they're not taking it. They're getting lawyers involved.
Within 60 days or 30 days, whatever.
Once they've missed that first payment, they're gonna get a notice. Second payment, you're at the clock's running, your lawyers are involved at that point, right? Alternative are dealing with higher risk clients, guys. There's a very small threshold for how long we want them. However, with that being said, I'm actually gonna add to this. I'm seeing an uptick of clients who are missing mortgage payments. Okay. We as an alternative lender are not looking to bail out people in the sense that if somebody's missed 6 mortgage payments, we're not taking them on. They've clearly shown that their obligation to pay the lender is not their focus. And it's not maybe a fault of their own. Maybe they've lost their job. Maybe, inflation is high and they just can't keep up with everything. However, if we have a client with a story, I have one right now. They were 2 months in arrears. They missed 2 mortgage payments. The wife got diagnosed with cancer. Okay. Medications are extremely expensive. Those are the things that we might be able to do. That doesn't mean that we're putting them in the private market. That's when they call me and saying, Kelly, here's the situation. Here's the story. Because if I just get, hey, Kelly, we got a client who's in mortgage arrears. Can you do it? I'm going to say, no, I need the story. I need to understand what happened. Because if they're just irresponsible because they've gone to the casino 95,000 times and spent 100 times more than what they make, it's not something that a lender is going to take on. However, if there's a story behind it, like the one I just gave you, it's something that we might consider. Okay.
How's the delinquency rate these days?
So with RFA, we're extremely good right now. But that's also because we really opened up within the last 2 years aggressively on the alternative side. The delinquency rate with some of the bigger competitors is not good right now, right? Alternatives, high risk deals. But the good thing is, guys, is that the alternative lenders are looking for solutions. They're not looking at a client who's just missing a mortgage payment and saying, sorry, you're out, power sale. It's not what they're doing. They're calling them, they're re-amortizing the loans. They're doing stuff, dropping payments. They're doing what they can to help the clients keep the house. Okay. Nobody wants to see a flood of power sales on the market. So we're doing everything we can.
These properties get taken over and they go on.
Absolutely.
Sale.
Absolutely.
Have brokerages or agents or anybody you work with, or at least on a one-to-one, who's got the deal with that, or
Once it's gone into power of sale, so as a lender, we have a lawyer. Here you go. Our client's 60 days in arrears. You need to reach out to them. I know nothing about it at that point.
son.
I don't even know my deals that are going into power sale. They're not brought up to us. That is dealt with completely separately with legal department. We have no idea. Okay.
Do you guys care if people have done their taxes?
Nope. No government documents. Do we care if people have filed taxes? No.
Wow.
Okay. However, there is a self-declared form for business for self people. And there's a little check mark and says, do I owe the CRA any arrears? Do what you want with that.
No, this is like an insurance company. You answer 5 questions and you've got $1 million coverage. God forbid you die 3 months from now. They look at what you said, no.
I got reassessed. Story for everything on the alternative side. This is the conversations Vera and I have off the record, but I'm really glad that you're recording this call.
For quality.
Please don't share anything shit.
You realize that.
No, I just thought of that right now. So I didn't incriminate myself. I said, do what you want with it anyways. Any other?
It's not RFA, all the alternate
Yes.
lenders, they have pretty much very similar policies.
Yes. Yeah. Are there any other questions?
Based on the loan amount,
The what?
the fee, 1% fee,
Yes, based on the loan amount.
the loan,
Yes, correct.
2% was for.
If we want to buy down the rate, if we want to get the rate down low, if clients are really rate sensitive and not fee, we can go. It doesn't have to be 2, guys. It can be 1.25. Let's say we just have to get the client down 0.25% because that would make them happy, right down to 4.99. They want to see the 4, right? We have room to play with our rates. It's literally a mental thing. They don't understand. We're taking from Peter to give to Paul, but at the end of the day, They're rate sensitive. They're gonna see the 499, no problem. We'll give them the 499.
Depends on how you want to slice the cake.
It's, yeah, that's it. They have to decide. On a 1-year term, 1 additional percent fee would buy my rate down a whole percent. Yeah. So right now in a 1-year term, a good client, it's a 529 rate. I can get down to 429. It's exactly what it is. Yeah. Good.
Options.
Always solutions on the alternative side. What's what we try to do, right? When they don't fit within the banks.
Deal makers.
So, guys, I encourage you guys, if you have any questions, please, anytime, reach out to them. They got me at obviously their fingertips. I will always respond, very responsive. And happy selling. What? We're on 145 King Street. We're right in University. Yeah, King and University, downtown.
You know where to find.
Good luck. I'm never there.
She's working.
I'm on the road. You'll never find me. I'm everywhere. Thanks, guys. Have a good one.
Gonna say goodbye to our online people. We'll see you guys. So sorry you're missing lunch today.
Like, hold on.
This will be recorded and put on YouTube as well.
He's the troublemaker for the group. I can tell.
He sounded alright.
He's not all right.